Hey everyone, and welcome to today's class. Have you ever opened a trading chart and just felt completely overwhelmed by all those green and red bars dancing up and down? Well, don't worry. Today I'm going to pull back the curtain and show you exactly what they mean, how to read them, and how to understand the story that's unfolding behind each and every candle. By the end of this video, my goal is for you to look at any chart and read it with confidence, just like a seasoned trader. So, the first thing we need to understand is what we're actually trading. A trading instrument is simply the asset you're buying or selling. This could be anything from commodities like gold, forex pairs like the euro versus the US dollar, stocks of companies like Apple or Tesla, or even entire market indices like the S&P 500. While each of these instruments has its own unique personality and moves differently, the beautiful thing is that the way we read their charts is fundamentally the same. For today's example, we're going to focus on XAUUSD, which is the symbol for gold traded against the US dollar. Gold is one of the most popular and heavily traded instruments in the world, and for good reason. It's known for reacting strongly to global news, economic data, and market volatility, which creates a lot of opportunities for traders. It's a great instrument to learn with because its movements are often very clear and defined. We'll use it to break down the concepts we're covering today, making it easy for you to see these principles in action on a real, live chart. Let's dive in. Now let's talk about one of the most crucial concepts for any new trader: time frames. Every single chart you look at can be viewed through different lenses or time frames. You might see options like 1 minute 1 meter, 5 minute 5 meters, 15 minute 15 meters, 1 hour 1H, 4 hour 4H, and even daily D. What does this mean? A 1 minute chart is a microscopic view, showing you a new candle and price action every single minute. It's fast-paced and detailed. A 50-minute chart zooms out a bit, giving you a broader perspective of the last few hours. Then, a 1 hour or daily chart shows you the bigger picture, the overall trend over days, weeks, or even months. Think of it like using Google Maps. When you zoom all the way in on a street, you see incredible detail: the trees, the houses, the individual cars. But you have no idea if that street is leading you toward your final destination. When you zoom out, you lose some of that fine detail, but you gain a clear view of the entire journey, the major highways, and the overall direction you need to go. In trading, using different time frames together helps you see both the small details and the grand journey of the price. Alright, let's get to the heart of the chart, the candles or bars. Each one of these little rectangles tells a powerful story about the battle between buyers and sellers during a specific period. A green candle is a victory for the buyers. It means that during that time frame, buyers were more aggressive, pushing the price up from where it started. It's a sign of strength and buying pressure. Conversely, a red candle represents a win for the sellers. It shows that sellers were in control, pushing the price down. It's a sign of weakness and selling pressure. But there's more to it. Each candle gives us four critical pieces of information: the open, the close, the high, and the low. The open is the price at the very beginning of the candle's time period. The close is the price at the very end. The high is the absolute highest point the price reached, often represented by a thin line or wick above the body. And the low is the absolute lowest point it reached, shown by the wick below the body. Let's look at a real example right here on the chart. See this big green candle? So, how do we use this information to make a trade? Let's walk through a simple, practical example. Imagine we're looking at the 15-minute chart for gold. We see a series of red candles showing the price is falling. But then, a strong, decisive green candle appears, completely engulfing the previous red one. This pattern could signal a potential reversal. The sellers are running out of steam, and the buyers are stepping in with force. A classic beginner's trade idea based on this could be to enter a buy trade once the next candle breaks above the high of that strong green candle. This confirms the buyers are still in control. To manage our risk, we'd place a stop loss just below the low of the last red candle. This is our safety net. If the trade goes against us and hits this price, our position closes automatically to limit our loss. For our target, we could set a take profit at a level that gives us a 1-to-2 risk-to-reward ratio. This means for every dollar we're risking, we're aiming to make 2. Look here on the screen. I'm drawing the entry line, the stop-loss line, and the take profit line. This visual plan turns trading from a guessing game into a strategic process. We aren't just hoping the price goes up. We are reading the story the candles are telling us and following the evidence that the price action provides. This is the foundation of technical analysis. Now you might be wondering, why are the colors so important? It's really about psychology and speed. Our brains are wired to process colors instantly. When you glance at a chart, a sea of green immediately signals upward momentum and buyer dominance. A wall of red instantly tells you that sellers are in control and the price is falling. This allows you to assess the market's mood in a fraction of a second. However, and this is a crucial point, you should never ever place a trade just because you see a single green or red candle. That's like trying to predict the entire plot of a movie from a single frame. Instead, you need to look for the context. Look for patterns. Are you seeing a series of green candles making higher highs and higher lows? That's an uptrend. Are you seeing a sequence of red candles creating lower lows and lower highs? That's a downtrend. The colors help you spot the momentum, but the patterns tell you the story. Before we wrap up, I want to leave you with a few key tips that every single beginner must follow. First, and I can't stress this enough, always start with a demo account. This lets you practice with virtual money so you can learn the ropes without any real financial risk. Second, spend time just observing. Study how candles form and behave on different time frames. See how a strong move on the 5-minute chart looks on the 1-hour chart. Third, practice strict risk management. Never risk more than 1 to 2% of your account on a single trade. This protects your capital and keeps you in the game. And finally, keep your emotions in check. Create a trading plan and follow it religiously. Don't let fear or greed dictate your decisions. And there you have it. You now have a solid foundation for understanding what each candle means, how time frames work, and the basic mechanics of placing your first trade safely. You've taken a huge step from being a confused spectator to becoming an informed analyst. If you found this video helpful and want to continue your learning journey, make sure to hit that subscribe button. In our next class, we're going to dive into support and resistance, the invisible levels that act as the secret behind almost every major price move. Thanks so much for watching. Remember, every expert trader was once a beginner just like you. The key is to keep learning, stay disciplined, and never give up. See you in the next one.